It's a pleasure to introduce Stan Druckenmiller. Stan and I go back 50 years to college together. Over that period, ironically, we both ended up in similar businesses, although in different aspects. As some of you know, I'm a credit guy in nuts and bolts, and Stan is macro and an extraordinary investor in that realm. Not only is he an extraordinary investor, I would say legendary investor, but he also is quite a generous philanthropist of his treasure and of his time. And I've had the involvement with Stan on some of those aspects. There's a saying in the business that there are old investors and there are bold investors, but there aren't many old and bold investors. Stan Druckenmiller is the exception. Now, I can get away with it because I'm a year older than Stan. And obviously, it's a statement that's true. Stan is a real student of the markets, has delivered extraordinary results. He has been kind enough to give us 20-minute presentation, plus or minus, and 40 minutes for Q&A. So I think you're in for a real treat. Stan, thank you for agreeing again to speak to the SIF dinner at USC.
Thank you, Sheldon. If you can hear me, just shake your head. Just everything's good. Okay, good. This is actually my third interaction with USC in the last 8 years. It's the first one virtual, but I'm thrilled to be here. I will say it's about the most challenging time to talk about the market and economy I can remember since I got in the business. I actually believe we are in the most unique set of economic circumstances that I've seen in my career, and certainly in the post-war period. I believe policymakers are failing to acknowledge how unique this period is, and I think the consequences of that could be with us for years, if not decades to come. Now, why do I say the period is so unique? Well, first of all, the COVID-induced decline that we experienced last spring was both violent and abrupt. To put it into math terms, we had 5 times the decline in the average recession in 25% of the time. Think about that. So 5 times the average World War II recession decline in 25% of the time. Monetary and fiscal policy's response to that was equally unprecedented. It's not pleasant to remember back last spring, but if you think about that period, I think we were all terrified that we were experiencing a potential black hole, not only in our lives, but in the economy itself, with potentially catastrophic consequences. If you look at the policy response, it was extremely aggressive. Led by the CARES Act, in 3 months, we increased the government deficit more than the last 5 recessions combined. So if you took the Reagan 82 recession, the Saddam Hussein 90 recession, the dot-com recession, the great financial crisis, you added up all those recession's effect on our budget and the size of the budget deficit combined, they do not equal how much the budget deficit increased in 3 months last spring. The Fed response was equally aggressive and unprecedented. They did more QE in 6 weeks last spring than they did in the entire period from 2009 to 2018, which you'll remember was somewhat unprecedented in and of itself. And a lot of people were questioning the size of that. Well, the peak month during that 9-year period was when Bernanke did 85 billion in QE. We're still buying 120 billion in securities after the 6 weeks that I talked about. The final thing that happened last spring was we crossed the Fed, crossed a lot of red lines in terms of what they would backstop in terms of corporate debt, also in the municipal market. The results were very emphatic. Corporations increased their debt in a recession. I don't believe it's ever happened before, over $1 trillion in response to the Fed backstopping that debt. Just to put that into perspective, in the great financial crisis, they shrunk their balance sheets $500 billion, which is much more, I'd say, in consistent with historical activity. The good news is this has resulted, I'd say, pleasantly, surprisingly, in a very abrupt and strong recovery. In that context, it was a good risk reward to enact policy expecting a deep and protracted recession in the spring of 2020. It worked, it was dynamic, it was bold. However, a lot has changed since then. By the fall, the outlook had already brightened considerably, and policy support continues to accelerate. Fiscal deficits are going to reach 30% of GDP in just under 2 years. Okay. I'm going to share a screen with you. This is a chart of the cumulative fiscal deficit from the start of the recession, of all the recessions that I mentioned earlier since 1980. And you'll see the top 4 lines are the 4 recessions that preceded this one. I'm sorry, the 5 recessions that preceded this one. And the black line is if you added up all those together. Remarkably, the red line is what we're doing in 2020 and 21. Again, the boldness of what they did in the beginning of that chart, when you say the first 5 or 6 or 7 months, makes a lot of sense. But what's very surprising is we're continuing to double down on these policies, even after it's quite apparent you've had a very strong recovery in the economy. The Fed's easy money will also top a similar amount, almost 2 times all previous Fed incursions into money printing. Now, what we have observed in recent months is the sharpest recovery from any downturn in recent history. Despite losing 11 million net jobs during 2020, personal income grew at the fastest rate it has grown in 20 years. Think about that. While 11 million people were losing their jobs in a year, we ended the year with the strongest growth in personal income in 20 years. The unemployment rate has recovered 70% of the initial hit in just 6 months. It typically takes 25 months for this to happen. Even after the sharp fall, again, 5 times the average recession, we're already back in terms of GDP to pre-COVID levels in just 5 quarters. The average recession takes 7 quarters, but don't forget, we're coming back from a much deeper hole that was 5 times as deep as that observed in the average recession. It is unnecessary and frankly reckless that 575 billion of the 850 billion in direct transfers of 2.5 trillion of expected QE are being provided after retail sales were above pre-COVID trends and after vaccine confirmation. So if you look at the red line on the chart I have up, that is 2020. I think we can all agree it doesn't look anything like the other recessions, which are more traditional in nature. Much more violent increase in unemployment, and then a huge snapback in a much shorter period of time. I think even moderate voices will agree that the level of support has been excessive. Let me show you how excessive it actually has been. This is a chart of retail sales the last 20 years. They are currently above pre-COVID trend by 15%. Look at the period from 2008 to 2014. It took 6 years to get retail sales back on trend after the great financial crisis. But if you look at the current period, we had a sharp V bottom out, and I mentioned the CARES Act. That's check one. Then we had more fiscal stimulus last fall after vaccines were apparent and after it was apparent that we were in a very unusual recovery. And now, as you know, we've just passed another $1.5 trillion of stimulus when retail sales are 15% above trend. What does that mean exactly? If you took the increase in retail sales from 2016 to 2020 on this chart, that's 3% a year in a recovery. We've just done that in 6 months. We are absolutely booming. We are above trend by, frankly, 5 years in 6 months. Okay. Now we have, let's talk about the Fed's excessive support. The Fed has constantly reminded us that monetary policy acts with long and variable lags. Why then is the Fed still providing emergency financial conditions when the recovery, as I've shown, is in full acceleration? Why are we buying $40 billion of mortgages a month when we are clearly running out of housing supply? Not only is the Fed still providing record amounts of accommodation, it is promising not to raise rates until after 2023, even when the recession is already over. If the Fed raised rates in the first quarter of 2024, as indicated, it will be 41 months after recovering 70% of the drawdown in unemployment. That was the chart I showed with the red line earlier. What do you think the average number of months before the Fed's first hike after a 70% employment recovery is in the post-war period? So it's 41 months that Chairman Powell is projecting. What do you think the average after that kind of recovery has been since World War II? 4 months. 4. And according to the chair, they are not even thinking about ending $120 billion a month of bond purchases. Simply put, the fastest and strongest recovery from any post-war recession is being met with the Fed's easiest response on record, by a mile. Policymakers say we need to go big to avoid downside risks and avoid the stagnation experienced after the great financial crisis. But as I have shown, comparisons with the great financial crisis are completely inappropriate. What about the risks of financial stability? The worst economic periods of the last century have followed the bursting of asset bubbles. Think the 30s after the 29 bubble burst, and think about the great financial crisis after the housing bubble burst. With Dogecoin, which was started as a joke with a $60 billion market cap, and NFTs on everything you can spell out there, is there any doubt in anybody's mind that we're in a bubble? Not to mention stock market to GDP is well above any level that we've seen in the past century. More ominously, what about the risk of fiscal dominance and loss of our reserve currency status? All right, let's see if I can do this without help this time. This is a chart of foreign purchase of US bonds. Frankly, US treasuries have been the go-to assets for global portfolio managers for the better part of 20 years. They've particularly been attracted to them as a safe haven in so-called risk-off periods. Look at the period surrounding the great financial crisis. Look at all the green above the line. Something stunning happened last March. In the middle of the equity meltdown, foreigners aggressively sold treasuries as we proposed the CARES Act. So I'll never forget it. Right in the middle of the worst part of the equity meltdown in the 3rd week of March, there was an 18-point decline in the bond market. We didn't know what it was at the time, but we found out months later through Fed accounts that foreigners had sold $1 trillion worth of bonds in response to the CARES Act. Again, this has never happened before, but They are watching our behavior, most of which I've outlined in the last 5 or 10 minutes, and they're frankly saying no mas. Asians and others have been purchasing Chinese assets who have done no QE and much less fiscal stimulus in response to COVID, and they're doing just fine, thank you very much. With China representing 20% of world GDP and only 1.6% of global portfolios, and the US representing 25% of GDP, but 28% of world portfolios. Remember, China 1.6%. This process is probably early rather than late. And the last thing the US needs is interest rate burdens. As the last few administrations have refused to mitigate the growth in entitlements, knowing that we were entering a great boom as baby boomers turned 65, debt to GDP was already set to cross 100% in the next decade. I mentioned earlier I'd been to USC before. Back in 2013, it was part of my college tour to outline the problem of the gray boom. Basically, since the Great Society, various programs have increased entitlements per person in the United States dramatically. What I was worried about back in 2013 is guys like me and Sheldon that were born a few years after World War II were all about to turn 65, and there was a lot of us. It was called the baby boom, and it was about to turn into a gray boom. The problem is Social Security and Medicare were on a pay-as-you-go system, and as we were about to receive all these benefits, there was less workers available to provide it. That was the problem I outlined back then. We are now throwing $6 trillion of extra spending into the pot just as the gray boom accelerates. Ironically, one of the answers I would give when I was inevitably asked what to do about the problem, I said we should raise the age of Medicare. People are living longer, people are healthier. The Biden administration is requesting to lower the age of Medicare to 60, creating a $400 billion hole in the name of infrastructure. I mean, seriously, you can't make it up. All of this spending has been encouraged by the Fed and aided and vetted by QE and low rates to finance it. There is no way bond yields would not have gone up without the Fed financing all the things that I've been showing the last 5 or 10 minutes. But look at this chart. The CBO projects that the new debt level, despite drastic cuts in the growth of non-entitlement spending, that's the gray line, will result in interest expense of 27% per year if the 10-year rate was to normalize to 4.9%. Simply put, the system cannot handle it, so the Fed will be forced to monetize it. Think about that, 27% of GDP just in interest costs alone. That's basically all the money we've spent in COVID relief in the last 12 months. Like many post-war periods, this will inevitably lead to inflation and financial repression by central banks, despite not having had to finance a major war. I believe we have crossed the Rubicon, and this is the only solution for this unnecessary and self-inflicted situation from this radical monetary and fiscal policy I've outlined. Currently, 85% of the world's transactions are done in dollars. I think we have crossed the Rubicon, as I said, and for the first time in my career, I believe we will lose this reserve currency status and all the benefits that come with it within 15 years. I've never said this before, I've never even thought it before. At present, there is no alternative because of the lack of the trust in the communist dictatorship in China and the mess that Europe currently is. I don't know who's going to replace us, but my best guess is the biggest threat is a crypto-derived ledger system that will be invented by a group from an army of engineers leaving universities, like USC. I will conclude my remarks with how my family office is positioned given this backdrop. This comes with a huge word of caution. For those who know of me, My intermediate view is very flexible, and I do change my mind. I see I've used up my 20 minutes. Let me just say that for obvious reasons, we are positioning ourselves short the dollar. I think you'll understand that from what I presented in the presentation. One might ask, in terms of shorting the dollar, why did the dollar not go down when foreigners started selling bonds last March and have continued to sell them through today? So as opposed to 500 billion in bonds flowing into the United States a year, they're now flowing out. The answer is it happened in COVID. And as you all know, and I think some of the earlier speakers alluded to it, the students, COVID was extremely beneficial for companies that serve the digital economy. It just so happened that the FANG stocks and many US companies like Zoom were better positioned to deal with COVID than any of our finer counterparts. So we had a huge inflow into the equity market here that made up for the change in the bond flow. Once valuations got high, that dissipated and the dollar peaked out in July. We've recently had a bounce that I think is unsustainable. That bounce is frankly because US growth outlook has picked up relative to others because of our vaccine rollout. But as soon as the vaccine rollout catches up in Europe and Asia, which I don't think will be far behind, I think the downtrend in the dollar will resume. We are short global fixed income. The booming economy I've outlined. I just think 1.6% on 10 years is ridiculous price, particularly relative to history. They've historically traded right on top of nominal GDP, which is running at 10%. I'm not predicting that, as I said earlier, we'll never get there. The other way we positioned ourselves for this inflationary outcome is we're long all sorts of commodities. We've been long oil, we've been long copper, we've been long the grains. Pretty much if it moves, we're long it in the commodity world. And finally, equities, we are long, but I will be very surprised if we don't make the exit by the end of this year. I was lucky enough to just start Duquesne as Ronald Reagan entered with Paul Volcker running the Fed. And as you know, many commentaries, everyone pretty much agrees that the combination of Jerome Powell and the Biden administration is an unraveling and the exact opposite of what Reagan and Volcker did. And I don't really see how the S&P, I think, was 780 at the time, or the Dow was 780. We've gone up 5, 10, 15, 20 fold since then. If Reagan and Volcker were so bullish, I don't think what we're doing now in terms of regulation, taxation, is sustainable. And I will remind those, if you invested when Ronald Reagan was elected, because of Volcker, you lost a lot of money the first 18 months. So they did not take a myopic view and the dividends paid 20 years. I think today we're very much in the opposite situation. I've overstayed my welcome in terms of time, and I'm happy to answer any questions.
Thanks, Stan. Appreciate it. And thank you so much for joining us. And certainly for me, this is a true honor. For those just joining, I'm Rubin Miller, SIF class of 2015, and I'll help moderate our Q&A. I did see during the presentation, the Babcock California Fund, one of their big takeaways from this past year was take bigger positions in high conviction ideas. So I do think we have the right keynote speaker, and I am looking forward to diving in a little bit. I heard you, Stan, mention Dogecoin and potential loss of the US's currency status. So no doubt we are in for a colorful Q&A. Just a few kind of housekeeping items. SIF board members are all now co-hosts of this meeting. So I will kick us off with a few questions. And then like last year, I'll pause and allow for discussion among Stan and the board. Any other attendees with questions, please send them through the chat to me and I will do my best to integrate them into our conversation tonight. I've already gotten about 15 of them, Stan, so we'll have a lot to chew on. And with that, I'm really looking forward to this. why don't we start here? This will, for many of the graduating members, Stan, be their last formal education experience.
Congratulations.
Thank you to them, yeah. Any formative educational moments or mentors in your life that you recall as particularly impactful?
Oh, absolutely. I was hired when I was 23 years old at Pittsburgh National Bank. And I worked for a very eccentric, brilliant investor who made me at the age of 25, this was 1978, director of research, which was basically the #2 position in the investment division of the bank. And all the people that would be reporting to me were 35 or 40 years old, and they had MBAs, and I did not have an MBA. And I was a little confused. Also, I was a little cocky and arrogant. I was 25 years old. So when I walked in, he said to me, do you know the reason I'm promoting you above all these people? I said, no. He said, for the same reason they send 18-year-olds to war. You're too stupid and young to know not to charge. I said, what do you mean? He said, we've been in a bear market since 1968. It's been 10 years. You can't see them, but I have scars from being in a bear market for 10 years, and you're going to need to be able to pull the trigger. And I think you're going to be able to do that because you're too young and too inexperienced, and you won't have any scars. That man, in addition to putting me in a place, if you've read Malcolm Gladwell, to get my 10,000 hours by the age of, say, 27 or 28 as an investment guy, he taught me many things. A, to use technical analysis, which in academia at that time had always been frowned on as a counterbalance to my discipline. So I used fundamental and technical analysis in stocks. If there were 6,000 of them at the time, I would never buy a stock unless the fundamentals were great and the chart was great. If it didn't pass either of those tests, I was out. And he also taught me, probably the most important lesson, was never, ever think in the present. That's a good way to lose money. Try and envision the world in 18 months, 12 to 18 months out, how different it might be, because security prices will be much different. There's not one thing in the world that doesn't affect the price of some security somewhere. And if you can envision the world 12 to 18 months ahead and not look at historic earnings or where we are now, you'll make money. But if you're buying things that are very popular now, you're probably going to lose money because things tend to change and everybody else is long them too. That's what he taught me. My second mentor, I was lucky enough to work for George Soros, and that I can put in a nutshell, which was it's not whether you're right or you're wrong, it's how much money you make when you're right and how much you lose when you're wrong. He was constantly telling me to size up my positions. I'll never forget, I walked into his office and told him the fund at the time was $7 billion, that I wanted to put a $7 billion position on long the Deutschmark and short the pound. I explained my reasoning to him, which I thought was very sound. He looked at me with like the most disgusted look, and I was getting angry just with the body language feedback I was getting. And he said, look, you only get an opportunity like this. This is a one-way bet, maybe 2-3 times in your career, and you're just not betting enough. We shouldn't put 100% of the fund in this trade. We should put 200% of the fund in the trade, because the most you can lose in it is 0.5%, and you can make 20% in it. So your risk reward is tremendous. And he was constantly, I was shocked when I went there. He was not as good as predicting security prices to me, but he always seemed to make a ton of money because he would size his positions accordingly.
Thanks. You shared a little bit about in your talk, your current portfolio position, and then just now a little bit about some concentrated bets. You certainly have a reputation about that and betting with conviction and size. I don't think anyone would call you a Vanguard total market guy. this is a time-honored tradition at the SIF annual meeting, which is just a conversation around active management and its tiny cousin, passive investing. So I want to be a little bit more thoughtful about it with you. Not is it possible to outperform the market over time, but rather either are the massive amounts of money that are moving from active to passive missing an opportunity, or are there too many underperforming active managers to start with? And this is generally a good trend for investors.
Not to be a smart aleck, Rubin, but it depends on who's managing the money. I do think, because basically what I outlined from my first mentor, that most investors lack discipline. They get excited when things are great in a situation, and it's usually already in the price, that it's very likely that most investors will underperform the averages going forward as they have historically. But I think it's also apparent that there are investors that have historically outperformed the market, and they outperform by a lot, and I think that will continue. And if anything, in the future, I would say, what creates price movement? Change, big change. And with all the disruption going on in the world economy, in terms of digital transformation, in terms of labor, in terms of everything else, and if you look at the macro picture I just outlaid, which is potentially the most fruitful set of opportunities I've ever seen in terms of magnitude of change, I do think there will be investors who are willing to bet those and bet them big. And so it's just like stocks. If you can find the right active manager, that's great. But if you just go with the crowd, I don't think you're going to make money. I think I used to run a hedge fund, and I think I gave you a hedged answer.
I'll take it. Thanks. Okay, I do want to start moving to some of the questions I'm getting in the chat here. I know you all can't see them, so I'm kind of sifting through as we go. I'm getting several just on cryptocurrencies and Bitcoin and whatnot, Stan. So we kind of prepped for that. So I actually have a poll here for people joining us, and I'm just going to go ahead and launch that. So this question is for you all. Give it about 3 more seconds. All right. So there's our results of what percentage of your net worth is invested in cryptocurrencies. More than 50% is at zero. Looks like 20% are dabbling, between 2 and 10%. There's 13% of the people, and then people with above 10% of their net worth, looks like 6 people in the audience are there. So thanks for that. So Stan, maybe I'll leave it pretty open-ended for you, but one thing I'm particularly interested in is just your perspective on the expected return of cryptocurrencies, and we can get more granular if you want to use a specific one like Bitcoin, but what is the expected return of something like that? I know you're speaking publicly on it a little bit, and where do you sit on it?
Well, I'd be even dumber than I am if I gave you an expected return on cryptocurrencies. I don't think there's any way to know. They come in all shapes and sizes. I do think it's probable that we're going to end up with a ledger system that requires cryptocurrency as the medium to execute it. But I want to remind you that Facebook was the 11th social network. And before Google, there was a company called Yahoo. Well, I guess they sort of still are a company. But there's a very good chance, if cryptocurrency ends up being an actual medium exchanging currency, the winner not only has not been identified, it might not have even been invented yet. I wasn't just kidding when I was talking about this army of 25-year-olds. One of the things we've always looked at in investing privately is where are the hot young graduates from the great engineering schools going? And remarkably, I haven't understood it, probably because I'm approaching 68 years old. The lion's share of them are still going into crypto. And I think they will solve this problem in terms of using this stuff for a payment system. Bitcoin, I'm 1% on your chart. Kind of ashamed after I told you you're supposed to make big bets. I tried to buy 100 million of it last spring at 6,800. I bought 20 million. It took me about 10 days, and I said, the hell with this. This is too illiquid. I don't want to play with it. This was Bitcoin. And then I sold it back down to, that was only a 0.4% position. Then when I went to 36,000, I couldn't stand it. And I sold it down to a 1% position, and I haven't touched it since. But I don't think Bitcoin will ever be a currency. It doesn't make sense to me. There's too much volatility. I think if there is a currency, it'll be something else. But it does look like, and I don't disagree with Charlie Munger, that this thing's been created out of thin air. But you know what? There's a painting above my fireplace in the living room that's worth more than my apartment. And if someone thinks that's worth what it is, that's what it is. And for whatever reason, millennials, and maybe more importantly, zillionaires on the West Coast in the technology economy prefer Bitcoin to gold. And it's been around 13 or 14 years now. It's a brand, so it's probably here to stay. And right now you're in a space sort of like an elephant trying to get through a keyhole. The people that own this are sort of religious zealots, and now you have institutions coming in. So I wouldn't doubt that Bitcoin continues to go higher. But as you can tell, I don't really believe in it or not believe in it. So I only have 1% of my net worth in it.
Great, thanks, Stan. I'm going to pause here, and I'm going to let the board of directors of SIF jump in a conversation with you. So you all should be able to unmute yourselves if you want to ask Stan a question.
Stan, I have a question. Can you hear me?
Yes, I can.
This is Larry Tastian. Thank you for the presentation. It was very thought-provoking, and given a lot of us have been in the money management business for a long time, we couldn't disagree with anything you said. Could you give us some thoughts on some areas you didn't talk about that I think play consistently into your theme? It seems like your point earlier of skating to the puck, if you will, 12 to 18 months from now. What are your thoughts on income diversity, tax policy, the social unrest that we're going through today, more left-leaning, not making a political statement at all, but a more left-leaning administration? And I think you mentioned the impact on your thoughts on the dollar.
Okay, there's a lot in there. So what I leave out, just remind me, because you noted about 4 different things, but let's start with inequality. And as Sheldon knows, I'm co-founder of the Harlem Children's Zone. I am not a Johnny-come-lately to this issue, but let's start with the Fed and inequality. I don't think there has been any greater engine of inequality than the Federal Reserve Bank of the United States the last 11 years. So hearing the chairman talk about visiting homeless shelters is very, very rich indeed. I just had the best year I've had in 15 years last year. Everyone wealthy I know is making a fortune. And why are we making it? Because this guy is printing money like there's no tomorrow. And the kids in Harlem, in my opinion, are not benefiting from money printing, but Stan Druckenmiller and other wealthy people are. So for the life of me, I can't figure out why the left is so excited about money printing when all the data says the people that benefit from money printing are rich people that know how to navigate the markets. So that would be one answer to your question. I would also say that this thing, in my opinion, looking out 12 to 18 months, is going to take one of two paths. As you can tell by my portfolio, I'm betting on reflation. I'm hearing it from companies. When you grew the money supply at 25% for a year, it makes sense. It's historically correct. We have a whole generation who haven't seen it for 10 or 12 months, so they can't even deal with the concept. Chairman Powell likes to say, we're not going to have inflation because it hasn't been persistent and it hadn't been around. Well, what the hell? We had no inflation from 55 to 70 for 15 years. And if you went by that, we couldn't have any inflation. And then we had the 70s when we got guns and butter. And what I just showed you is about 5x guns and butter. So I think the odds on bet is we're going to have inflation. And inflation is going to hurt poor people, again, a lot more than rich people. Now, let's suppose I'm wrong. I mentioned earlier that anything I say on the markets is a word of caution because I changed my mind. But how does this thing end? To me, the asset bubble, which he's blowing up into unbelievable proportions, busts before the inflation ever really manifests itself. That's what happened with the housing thing in 08, 09. We never really got to the inflation because the asset bubble burst. Not dissimilar to what happened in 29. That's not my central case, but let me just say, we've never had a deflationary bust because inflation was too close to zero or 1.5 instead of 2. We've had them because we've had these tremendous asset bubbles. It happened here in 29. It happened in Japan in 90. And obviously it happened in the great financial crisis. And there is no one, no group that will get hurt more by a bust than the poor. They will be first in line to get screwed, trust me. In terms of the dollar, I think I covered that pretty heavily, but I'll just reiterate that talk about American exceptionalism, which is what a lot of current money managers say is their case for the dollar. I started using that term way back in the 90s. There is nothing exceptional about what I presented to you other than, to me, our stupidity. And everything that has made American exceptional economically, which is a meritocracy, which is the American dream, which is not taxing producers, is shifting now. I don't want to make a political comment about taxation. I'll just say, historically, the outcome economically has not been great. I am very sympathetic to the fact that I shouldn't be paying a lower tax rate than the plumber on my capital gains. And I have no problem with them going up a certain amount. But I also say their own joint tax committee did a study, and they're going to lose revenues if they raise capital gains to 43%. And no matter how heinous you find it that rich people are paying a lower tax rate than you want them to, if they just go about avoiding that tax, it does not make any sense to me to raise tax rates if it does not increase revenues. I think I answered 3 of your 12 questions, so maybe we'll move on.
Thank you. That's enough.
Thanks, Larry. Anyone else from the board want to ask any questions? They might let you off easy, Stan.
Would be great.
All right, I'll ask one then. Stan, many students and those graduating will go on to kind of work in equity research, portfolio management, hedge funds. And I actually suppose this question is more not just about investing, but maybe a little bit about kind of life. When you assess decisions that you've made or didn't make, what does that process look like? And how do you consider how high quality or low quality your decision making was?
Well, I've been extremely fortunate. I think maybe the most important decision you'll ever make is your partner in life. So marriage, you better choose properly there. I screwed it up the first time. I was 22 out of Bowdoin. I had a practice marriage. It lasted 2 years, no kids, and I got a second chance, and that worked out. But if you don't get that one right, that's not great. And I'd say in that realm, there's a lot more important than looks and temporary passion, and you got to look at the whole picture. In terms of a profession, I was extremely fortunate to be in a profession that in my 20s, I'd go to work at 6 in the morning, I'd come home at 11 at night, not because I was trying to make a bunch of money. I just loved the business. There's nothing I found more exciting than what I described earlier, is this gigantic puzzle where you try and predict how things are going to evolve in the world and how security prices might respond to them. So I know it's like a cliche, but a lot of cliches are there for a reason, and you've got to be passionate. And if you're coming into the investment business, I promise you, if you're coming into it just kind of because it looks like the best financial return to you, but you're not all that passionate about it, you're going to lose. Because every time you make a trade, you're trading against somebody who is passionate and probably working harder, and you'll be behind the 8 ball. So whatever the profession is, a not-for-profit to help disadvantaged kids, my business, medicine, whatever it is, you're going to spend 50, 60, 70 hours of your week there, and you're not going to be happy if you're not enjoying it. And it takes more than just the outcome of financial remuneration to make you happy. I'm just extremely fortunate that I got into a business that I loved, that the financial remuneration is ridiculous relative to what it yields to society. I mean, why I make more than a doctor is, well, it is what it is.
Thanks. I'll pause again. Jim, I see a hand up.
Yeah.
Good to see you, buddy.
Rubin, thank you. Thank you for, I thought I'd try to follow good etiquette, raise my hand. Stan, thank you very much for your comments. Really appreciate it. And lots of thought-provoking thoughts and opinions. And I really do appreciate it. Stan, we've all been in the business a long time. And I guess my question is a little bit more about our industry. And one of the things that at least I think we've seen is arguably a gradual, and some might argue not so gradual, increase in short-termism and focus on the short term rather than the long term, particularly, much more so in the public markets than in the private markets that inherently have a longer time horizon. But for those of us that are more focused on the public markets, it's difficult, kind of that trade-off between making bets that will pay off over the long term and yet having to maintain a business and grow a business and keep clients and grow clients and all so on and so forth. What do you have to say about that? And do you see this ever changing?
Well, that's a great question, and it's just brutal because I remember a lot of people that fought the dot-com bubble in '99. They went out of business because their clients were looking at 60 or 70% returns. And then I also remember Cap Research, who stuck to their guns and lost like half their assets. And then 3 or 4 years later, they were rewarded for their patience and they were just killing it. I think it depends on the manager. But I'd say the great majority, you're going to do better not taking a myopic view, trying to stick with positions and think longer term. There are certain managers who like to trade. I'm guilty of that sin at times. But I think by and large, in terms of the business, one thing you can do is really, really communicate your investment philosophy with your clients. So when you're fighting what might be a short-term mania, you've explained to them in the advance what your plan was, why you were going to do that plan and you're just executing on that plan. They're much more likely to stay with you if you've prepped on that. And I know this is easy for me to say, but I also think it's important how you choose your clients. I threw every fund to fund out of Duquesne in 1993. It's the smartest thing I ever did. By the way, once individuals heard about it, money just wanted to fly in. It was sort of reverse marketing. But I think it's really important that you educate your clients to whatever your investment philosophy is. One more thing I'd like to say about the myopia of investing. Part of the problem is the myopia of our policymakers. I mean, if you look at what Ronald Reagan and Paul Volcker did, Volcker engineered a recession to break inflation. Can you imagine in today's world, some Fed chairman standing up saying that we're going to do whatever it takes and break inflation, including knock the hell out of the economy? It wouldn't happen. It wouldn't happen. And this myopia is frankly a disaster because that led to maybe 20, 30 years of prosperity. And now we're using the new bar is we got to have full employment. Well, I don't know about USC, but at Bowdoin, employment is in the lagging indicators. So the Federal Reserve, who's supposed to be forward-looking by 24 months, they want to be at full employment before they stop doing QE and raising. It's just absurd. Anyway, that's how I stand on that. But I feel the pain of investment managers. It's tough. It's tough, and some of them won't make it because of this phenomenon. But just sort of one of the risks in the business.
Jim, thanks. Obviously, if we could make this MBA program 20 years long, we could finally get some statistically significant alpha from these portfolio managers here. Sarah, we're getting a few more questions come in. We have about 8 minutes left. I thought I would just ask you one that I've gotten a couple times tonight, which is just your thoughts on SPACs.
Just part of the mania. I could have included them with Dogecoin and it's a unique way to raise money. There's probably 5 or 10 out of the 200 that are deserved, and it was a better way. But to me, Rubin, I could give you 20 examples, and every one of them comes down to free money and speculation. I was with my sister-in-laws last night, who I haven't seen in years, and I've known them for 30 years, and they've never asked me about a stock, and they wouldn't leave me alone. All they wanted was an investment idea. But SPACs are just one manifestation of that. I don't like them. I think they're terrible. I wouldn't not own a company because it was a SPAC. You never say never. There might be a diamond in the rough, but you're looking for a diamond in the rough because most of these things are just big pump and dump jobs in frankly, the biggest mania I've seen in my lifetime, not just SPAC mania, the overall mania. You're on mute.
Thanks, Stan. Anyone else from the board with a question for Stan? No?
And are we going to have to wait another 5 years to get you back here?
I think I might be done. We'll see what your responses are after the talk.
All right. Thanks, Stan.
I don't think it's been exactly uplifting. Although I will say this is really not only sort of risky, but it's also just interesting as hell. Because when I said in my first opening remarks how unique it was, I hope it's never repeated. I don't know how it's going to end, but it's going to end badly. I just don't know when. And to Jim's point earlier, I'm glad I don't have any clients, because if you bet against it ending too soon and you're wrong, you might not have any clients by the time it ends. Very challenging.
Thanks. We'll probably do about 2 more questions here, Stan. One that I got is kind of post Great Financial Crisis of the last, say, 12 or so years. What's the biggest investment lesson you've learned in that time period?
that I learned that I made 70% of my money previous to that in bonds and currencies, and when the central bank squashed them, I wasn't as good as I thought I was. I don't know how much I learned. I think, you know, we went through maybe the greatest innovative period since Industrial Revolution in terms of change. But I don't think I learned that. But, you know, I think some people are going to learn in the next 5 or 10 years that that's not going to last forever, and these valuations aren't going to last forever. But it's been a period for equity managers, and I'm just glad I did not make the returns I made before I quit until last year. I'm just glad that I started in equities, because to me, you need a bunch of arrows in your quivers. And I was murdering everybody in the 90s because of bonds and currencies. And I can't keep up with these tech managers making 50% a year by just doing macro. But I've been in equities myself. I just haven't made the big bets because they weren't in my comfort zone, like we talked about earlier. I don't think I answered your question. Probably too old to learn anything at this age.
No, it's great. I'm mindful of the time here, so just a few minutes. I'm going to try to get 2 more questions in. The first one is from the audience. Speaking of shorting stocks, do you still think there's value in the practice? It has come under scrutiny with the GameStop episode.
Yeah, those guys that got their clock cleaned in GameStop are some of the best investors on the planet. And, you know, hindsight is wonderful, and talking from the cheap seats is wonderful, but it all happened in like 2.5 days. I mean, I think any rational analysis, when that stock was 7, you thought it might go to 25 or 30, and then maybe in a mania it goes to 40. To think that it could have gone to 500 in a week is just kind of silly. Like everything else, Rubin, though, people tend to fight the last war, and the shorting environment has been as good as I've ever seen it. Percentage-wise, we've done better on our shorts than our longs, and supposedly an up market the last 2 or 3 months. And it's a tough game, and that's a new variable you got to consider, that being the Reddit crowd. But everything I described throughout my talk and where valuations are, SPACs and everything else, there's about as much opportunity as I've ever seen on the short side. So I wouldn't give up on it, but it's been a miserable 12 years trying to short stocks. And will be, but when this thing busts, it's going to be miserable long stocks like my poor boss had from 1968 to 1978.
Thanks. I am going to ask one more question, and then I'm going to turn it back to Professor Koo to kind of wrap us up. Sheldon mentioned your philanthropy efforts, and you touched on them a little bit as well. I think that's probably a good place to close. You were called the most charitable man in 2009 by the Chronicle of Philanthropy. Some graduating students here will go on to very lucrative careers, and at the very least, many will find themselves with the opportunity to give back financially to society. What role, kind of broadly speaking, has philanthropy played in your life, and how do you feel about giving away meaningful amounts of your money?
It's been a huge role. It's brought me great joy. And I'll say, I'm not necessarily a good person. I'm a selfish person, and I give money away because I love it. I love the joy of watching lives change and being able to shape things. And again, I don't feel guilty about the money I made. I do think it's strange that I've gotten the financial remuneration I have versus a doctor. And I don't know whether you call it giving back or whatever, but if I can take that money and raise the prospects for the American dream in a lot of underserved neighborhoods, or if I can, through New York Stem Cell Foundation, end up having provided the fellowship for the guy that founded Moderna, or work on the environment with EDF, it just brings great joy. I'm a competitive person. I love winning in the investment game. I don't do it for money. I do it because I love competition. I love winning. but there's sort of an emotional, deeper joy and satisfaction I get with changing the outcomes for kids that didn't have the same opportunity I had. I don't think anybody should be guaranteed an outcome, but it really, really sticks in my craw that some kids just don't have the chance I had at the American dream.
Stan, thanks so much for joining us tonight. It's been a real honor for me, and I'll turn it back to Professor Koo.
Thanks, Rubin.
Thank you, Stan, and thank you, Rubin. That was such an informative talk. I just wish, Stan, you didn't sugarcoat your views and were more direct.
Well, as I said, I do tend to change my mind. I could be wrong. I often am.
Thank you. Well, we very much appreciate you making the time for our students and all of us today. And I wanted to say again to the class of 2021, congratulations.